When people hear estate planning, they usually think legal documents and paperwork, but estate planning isn't just about the documents, it's about the decisions. It's about making sure that when you're no longer here, your family isn't left stressed, confused, or dealing with unnecessary financial complications. And here's something that many people don't realize. Estate planning only works properly when your investments and your insurance and your professional advisors are all aligned. Your lawyer drafts the will, your accountant looks at the taxes, but how your investments are structured, how your accounts are titled, and how your beneficiaries are named, those decisions have a critical impact on how everything unfolds when everything gets to the estate. And one of the most overlooked pieces is beneficiary designations. Now, many investment accounts and insurance policies allow you to name a beneficiary directly. So when you set up it properly, assets can transfer more smoothly and often more privately than going through the estate. But beneficiary designations can override your will. If they haven't been reviewed in years and life has changed, that can create serious problems. Marriage, divorce, children, business changes. Your plan needs to evolve as your life evolves. Now, insurance is another key piece. Most people think of insurance as income protection during their work years, but in estate planning, insurance creates liquidity, meaning immediate cash when you need it the most. Now, in Canada, for example, RRSPs and RRIFs, or Registered Retirement Savings Plans and Registered Retirement Income Funds, are generally taxed as income on your final or terminal tax return, unless transferred properly to a qualifying spouse or a qualifying dependent. And that can create a significant tax bill. Life insurance can provide tax-efficient funds to cover those taxes or support your family without forcing the sale of those investments or property at the wrong time. Then there are your non-registered investments, which may trigger capital gains at death. Now, all these investments, all these things are not inherently bad. It just needs intentional coordination. Good estate planning isn't about eliminating every tax, although that would be nice. It's about understanding where taxes may arise and planning intelligently around them. And most importantly, estate planning is, well, it's personal. Every family is different. Some people are focused on protecting a spouse. Others want to ensure long-term stability for their children. Business owners have an additional complexity when corporate and personal assets intersect, and there is no one-size-fits-all solution. When your financial strategy is aligned with your legal and tax planning, your estate plan becomes clearer, more efficient, and easier for your family to carry out when you're not here. And this isn't something you do once and just forget about. Beneficiaries should be reviewed, insurance needs to be reassessed, investment strategies should stay aligned as your life changes. And it seems like a lot of work, but in reality, small updates today can prevent major problems tomorrow. Now, at the end of the day, estate planning isn't about complexity, it's about clarity. It's about making sure that the people you care about are protected and that your financial life reflects your intentions.